Hello, everyone, and welcome to this presentation on Mastering Sensitivity Analysis and Capital Budgeting. My name is Angel Morales, and in this session, we will explore how sensitivity analysis helps makers assess the impact of uncertainty in financial projections to make better informed investment decisions. So let's get started. Very briefly, the purpose of this presentation is to equip you with the tools to conduct a sensitivity analysis, improve decision making, and assess project risk in capital budgeting. Let's start with the introduction. Sensitivity analysis is a technique used to evaluate how different values of an independent variable impacts a particular dependent variable under a given set of assumptions. In capital budgeting, it helps us analyze how uncertainty in factors like revenue, cost, of interest rates affects the viability of a project. Understanding these risks allow businesses to make informed financial decisions. It all starts with qualitative steps in sensitivity analysis. The first step in sensitivity analysis is identifying those key variables that impact project outcomes, such as its estimated cost, projected sales, and discount rates. Next, we will consult with experts such as financial analysts and industry professionals to gain insights into potential fluctuations in these variables. Finally, we define realistic ranges for each variable based on historical data. Industry benchmark and market trends help us determine what are the what are those variables that affects or benefit us in this analysis. Next, we move into quantitative steps in sensitivity analysis. Once we have our key variables and their potential ranges, we build a financial model of the project. We then systematically adjust one variable at a time while keeping the other constant. This is crucial. This allows us to see how each factor affects important financial metrics, such as net present value and internal rate of return. By testing different scenarios, we can determine which variable poses the highest risk to project success. After that, we need to analyze. Once we run the sensitivity analysis, we analyze the results using graphical tools, such as the tornado charts. This visuals helps highlight which variable have the most significant impact on project outcomes. Identifying these critical variables allow businesses to focus their mitigation strategies on the factors that matters most. Ultimately, this helps in determining whether a project is financially viable or if adjustments needs to be made. So, how do we incorporate risk to capital budgeting? Like to further integrate risk assessment into capital budgeting, we can use methods such as adjusting discount rates to reflect higher risk levels, running a scenarios analysis to explore best case and worst cases scenario, and utilizing a powerful tool as the Monte Carlo simulation. The Monte Carlo simulation provides a probabilistic approach by running thousands of possible scenarios to assess the likelihood of different outcomes. This techniques helps companies build a more resilient investment strategy. So, what have we discussed? First, the sensitivity analysis enhances decision making quality. It allows for better risk assessment in budgeting. Mastering these tools is essential and can lead to improved project outcomes. Continuous learning is essential in financial analysis, and we must leverage these resources available to deeper understanding if we want to be a successful business owner. What have we? These are some great resources for further reading on sensitivity analysis and its role in capital budgeting. I recommend these foundational finance textbooks. They provide an in depth explanation and practical applications of financial modeling techniques. Thank you for your time, and I hope this presentation has helped you understand the importance of sensitivity analysis in making informed financial decisions. Until next time.